Welcome everyone to the one-on-one Green Technology Investors series. I am joined today by Tony Yan of One on One, listed on NASDAQ as YDDL. So in this first video, we're going to dig pretty deep into the financial results from the first half of 2025 and what they actually reveal about the underlying trajectory of this business. All right, let's get into this. So Tony, in the first half of 2025, One on One reported net revenue of 28.1 million, which represents the growth of 50.7% year over year. So that's a pretty substantial number for a company at this stage. So before we get into the mechanics, what is the single most important thing that investors should understand about what drove that growth?
Well, yeah. The 50.7% figure request context. In early 2024, we were relocating our plant and production was partially stopped. So the revenue base for that period was low. The first half of 2025 reflects normal operations. Investors should expect a sustainable growth rate close to 20% per year, not 50%.
Wow. So net income grew 59.5% in that same period, which means the profits, they grew faster than revenue. So your gross margin expanded by 341 basis points to approximately 25.3%. So what I'd like you to do next, Tony, is if you could walk us through the cost structure that makes that kind of operating leverage possible and whether you see that margin trajectory as durable.
About 60% of margin improvement came from product mix. We have been increasing the share of copper alloy ingot in our output, and copper carries higher margins than aluminum. The remaining 40% came from raw material and copper price conditions. We operation with zero debt and an experienced production team. We expect the current margin level to be sustainable.
So the January 2026 announcement that confirmed that 39 million in customer contracts for the second half of 2025. So that's with 7,481 tons of finished product that is delivered. So that's a 12% volume increase year per year. So copper alloy ingots made up 71% of that contract value. So roughly 27.9 million. I mean, that is a highly concentrated product mix. So I guess my next question is, what does that concentration reflect about where you have pricing power and customer stickiness?
Actually, the concentration in copper is intentionally. We began shifting toward copper processing in middle 2024 when the supply deficit was becoming clear. Regarding our customers, the top 5 represent approximately 90% of revenue. This is a seller's market. Supply is below demand, and we can expand our customer base at any time. The repurchase rate is almost 100%, and the pricing is linked to the LME, which is standard for commodity transactions.
So the company carries zero interest-bearing debt. So for a company that is actively scaling, well, I mean, that's a deliberate choice with real implications. So how are you funding growth? And what does the debt-free balance sheet allow you to do that a more leveraged competitor cannot?
No debt means our cash flow is available entirely for business development. Capital expenditure will focus on new facilities, equipment, and working capital for procurement. To reach 50% capacity utilization, approximately $120 to $150 million would be required. To reach 80%, approximately 200 to 250 million. A company with significant debt obligations does not have this flexibility, but we do.
So given the H1 2025 results and the 39 million in H2 2025 contracts, so can you explain what financial milestones should investors be tracking closely over the next two reporting periods? And what would you tell on top of that? What would you tell the business is scaling the way you expect?
Yeah. Investors should monitor three indicators. First, revenue growth returning to our normalized rate of approximately 20% per year. Second, the continued increase in copper as a proportion of our product output. Third, volume from our Japan and Spain supply agreements begin to flow through. Most importantly, watch capacity utilization. That is the clearest measure of whether our strategy is being executed.
Wow. Well, thank you. Thank you. Because what we've seen in these results is a business where revenue growth, margin expansion, and volume increases are all moving in the same direction at the same time. So that combination, I mean, that is pretty rare. All right. So in our next video, what we're going to do is we're going to explore how One and One is building the international feedstock network that supports this trajectory, and specifically the company's moves into Japan and Europe. All right. Thank you, everyone.